Four of India's biggest private banks have just reported their Q3 FY26 numbers. At first glance, growth looks fine across the board. But when you look closer, a very clear difference starts to appear, not in loan growth, not in deposits, but in margins, provisioning, and balance sheet quality. In this video, we'll calmly break down the Q3 performance of HDFC Bank, ICICI Bank, Kotak Mahindra Bank, and Axis Bank, only comparing numbers, trends, and what the street is observing. Before going bank by bank, let's first understand the broader context. Across private banks in Q3, three themes stand out. First, credit growth remains healthy. Most private banks continue to grow advances in the mid-teens. Second, deposit competition remains intense. Banks with stronger retail deposit franchises are showing better margin stability. Third, the market's focus has clearly shifted. It's no longer just about growth numbers. It's about margin sustainability, provisioning discipline, and asset quality trends. Let's begin with HDFC Bank. HDFC Bank reported a quarter that reflected gradual improvement in operating metrics. Profit after tax stood at 18,654 crore, growing about 11.5% year-on-year. Net interest income grew 6.4% to 32,620 crore. Net interest margins improved to approximately 3.35%. Gross NPA remained stable at around 1.24%. What stands out this quarter is margin recovery. After a phase of pressure, margins have begun stabilizing, which is something the market has been closely tracking. Broker commentary highlights improving earnings visibility, while also noting that short-term stock movement may not always reflect long-term operating improvement. And this is where things start getting interesting, because while margins are improving for some banks, others are facing a very different set of challenges. Moving on to ICICI Bank. ICICI Bank reported profit of approximately 11,117 crore for Q3, reflecting a year-on-year decline. The softer performance was largely influenced by cost and income mix factors rather than asset quality stress. Retail lending momentum remained steady, and asset quality metrics continue to stay comfortable compared to historical levels. Market participants continue to view ICICI Bank as a well-managed franchise with consistent execution, even though this quarter did not meet all expectations. So far, we've seen margin recovery in one bank and earnings moderation in another. Now let's look at a bank where stability, not surprise, defines the story. Kotak Mahindra Bank's Q3 update reflects steady and predictable business momentum. Advances grew approximately 16% year-on-year. Deposits increased by about 15%. There were no sharp surprises in the numbers. Kotak continues to be viewed as a bank that prioritizes balance sheet strength and consistency over aggressive growth. Market commentary often categorizes Kotak as a steady operator, where long-term performance tends to be driven by disciplined execution rather than quarterly volatility. And now comes the most debated bank of this quarter, where growth is visible. But questions remain. Axis Bank reported solid growth in business metrics during Q3. Advances grew by around 14% year-on-year. Deposits grew close to 15%. However, profitability perception was influenced by provisioning and one-off items. Market discussions around Axis Bank currently focus on the trajectory of credit costs and how provisioning trends evolve over coming quarters. Broker commentary remains constructive on the franchise, while acknowledging that clarity on credit costs remains important. To summarize Q3 FY26 for private banks, growth remains broadly intact across all major players. The differentiation is emerging through net interest margins, credit cost behavior, and deposit franchise strength.